Well, hey, welcome to the show, everybody. Thank you for joining me. It's the Third Trader's Eyes podcast, and we are here on January 13th. It's a Monday, and the markets have opened down this week in the red. Dow Jones is down about 180 points, as you can see, about 1%. And as we go up the risk scale, so to speak, the S&P 500 down a little bit more, the NASDAQ down a little bit more, small caps and mid caps also down somewhere in the 1.5% range. Interest rates, of course, were down because people are buying Treasury bonds as a flight to safety. Now, apparently part of this was attributable to a Fed governor saying, yeah, the Fed may come in and continue reducing the bond purchases in $10 billion increments. And remember, that's what we want. We want the Fed out of the way. Well, here's the deal. If the Fed is still there buying bonds, markets go up regardless, right? It doesn't matter what the news is. As long as the Fed's buying bonds, that's good. Apparently, the stock market also spikes when the Fed is buying bonds and the economy is good. That's okay also. But what is the worst scenario for investors? It's when the economy is bad and the Fed's not there to bail everybody out, right? That's a worst case scenario. Well, that's exactly the scenario that we're seeing over the last couple of days. We had a bad jobs report on Friday, 74,000 jobs created last month, non-farm payrolls. You followed up with the Fed, at least members, being a little more aggressive on they're talking about reducing their bond purchases, right? So if you put those two things together, in the short term, you got an overbought stock market in the short term, you got a Fed tapering, and now you're getting some weak economic data. Run for the hills, and that's what they did today. So that's the setup. That's the rationale behind it. And again, is that going to continue? If you believe that the Fed is going to be aggressively taking away the punch bowl, and you believe that the economic numbers are going to continue to get worse and worse, then you should be selling stocks very quickly right now. If, on the other hand, you believe this is temporary, the market's overbought, yes, the Fed's going to taper, but they're going to do it at a methodical rate, and some of the data is still pretty good overall, then you let this settle in and you eventually buy the dip. And that's more of the camp that I'm in, because I think if you look back over the last 3 years, there's been 6 times that we've had a jobs report that was less than 100,000 of jobs added in that month, less than 100,000. 5 of those, there was big revisions. In other words, they come in the next month and they say, not only is this report better, but the one you saw last month, we're going to change those numbers and revise them up. So there's a good chance that the one we just got is going to be revised up, maybe even double what it was. And it's a little frustrating because you're trying to, some of you, trying to trade based on that data. Look, that's why you have to, use moving averages. I think even the best economists get it wrong most of the time. And so it's hard to use this. You have to look at the trends. And the jobs market, as pathetic as it is, has been improving over the last several months. Okay, so it was really pathetic, and now it's just a little pathetic. So it's getting a little better. But one jobs report spooked everybody, and maybe that was the rationale for selling. And it wasn't down a lot on Friday. But when you come in today and have, digesting that bad jobs report, and then you get some of these earnings that are coming in lackluster, especially in the retail sector, what do you get? You get a market that's of people freaking out, especially when the Fed's talking about taking away more of the stimulus. So that's what the setup is. But here's the Dow Jones. You can see again, we would probably draw the line in the sand here somewhere around 16,200. We're at 16,257. So 57 more points and you get your first little support. We could come down a little bit to the 50-day moving average there, the blue line. But I want to point out here before we get to the overall markets and the S&P, the thing that was down the most today was the retail sector. And I mentioned it just a minute ago. Retail, these reports haven't been good. And remember, why is that such a big deal? You may say, well, Carl, there's plenty of other sectors out there to invest in. That is true, but the consumer's 2/3 of the economy, okay? 2/3 of the economy. So it's important to see what the consumer is doing, because that is for a large part of the economy. And of course, if we look at this technically, you can see that the retail sector has clearly broken this 50-day moving average, which it really hasn't broken in a long time. I can go back all the way to before 2013. So we have to pay attention to that. Again, what we look for is a changing character. Is the market changing character? And it's not necessarily just the market. Is any investment you're in changing character? Something changing to make you go, yeah, I think this looks different than it's looked in the past. You could have said that here, right? You could have looked at that and said, you know what, it hasn't gone below that blue line in quite a while. I'm going to sell. Well, look what it did. It snapped back, and then all of a sudden the purple line became the new line in the sand. Well, now if that's broken, is the red line going to be the line in the sand? And maybe it is. Maybe it bounces off that, and up we go. But you have to pay attention to these things, because regardless, this doesn't look like a pretty picture. So, and I think, again, for those that are trading retail, you're right on support right there. So that's the first place it should bounce tomorrow. I mean, it literally should bounce tomorrow. If it doesn't, this line's going to come into play, and we're going to head down to there. And if it doesn't bounce there, then we're going to bounce a little bit higher perhaps, and then start to roll over. So watch retail. This could be setting up for this big head and shoulders in the future. Okay, so we could fall a little bit, bounce up to this old breakdown level, and then roll back over. But retail is a very important sector. What else was down today? Oil and gas exploration was down today. Nothing major here. It kind of had gone vertical, and now it's just settling in. This is the one that's interesting. Interest rates down today, and that's usually been good for housing stocks, and yet housing stocks were down 2.4% today. By the way, retail was down almost 3% today, about triple the losses of the S&P. But if you think interest rates are going to continue to rise, it's kind of hard to be in housing unless it's accompanied with a strong economy. So I think people are a little confused. Housing's a tough area to be in right now, because they had the good run last year, earlier in the year, and then of course interest rates rose. And what did that do? That pushed down these stocks, and they started to get some life back, especially as rates have stabilized around 3% on a 10-year Treasury, between 2.8 and 3%. But again, they have interest rates going either for or against them, and they have the economy either going for or against them. So that's a tough trade right now, but those were your kind of biggest losers of the day. Of course, on the upside today, you had gold, which is interesting. If you take a look at gold, nice little potential double bottom here. So that's something that if you are still unhappy with what the Federal Reserve is doing by printing the dollars and by putting all that money in the banking system, and you think that's going to cause rapid inflation, then this is not a bad time to look at gold. And if you're wanting to trade it, obviously you could take a look at the this little double bottom here. That would be your stop if you're trading it. If you have it for an investment, then you may just hang on to it. This is kind of the line it has to cross to really change its character, right? It's in a downtrend. It's been in a downtrend, and now you're starting to get a little bit of attention. And of course, it's a diversification tool. I am long GLD, but it's been more of an insurance policy, I guess you'd call it. But there's no question it's been the wrong place to be over the last 12 months, just as it was the right place to be over the last several years. But I don't think this trade is over. And of course, we talked about it late last year that don't be surprised in January if you see some mean reversion. So the things that were up the most may come down a little bit, and that's exactly what's happening with the stock market. On the flip side, gold, which has been getting killed, maybe you could see it get some bounce out of it. And so we may be just seeing that rotation a little bit. So watch gold, but it certainly has this nice little double bottom. Again, if you're wanting to trade it, you could use this area right here as your line in the sand, which on GLD would be, let's call it 115 or so. So that's only $6 lower than where it is right now. But so watch that. Watch gold. Obviously, treasuries had a good day today as people, the flight to safety there, and that looks like it could run a little bit. Again, this is a big fundamental move. Are treasuries going up just because it's a place to put your money as a little oversold, or is the economy not as strong as people thought, and they're going to go flock back to bonds again? I don't necessarily believe this trade. I think this trade could last, obviously, if the stock market sells off. That's the only reason I think it can go up. I don't think it's going to go up because the economy is cratering. I think people that are buying treasuries because they believe that jobs report last month, when they get that revised next month, all it's going to take is one good economic report, and treasuries are going to sell off again. So be careful about that. But how I would be using this is, I think by keeping your interest rate risk low. In other words, you're not betting on rates going down, but you're also not betting on them going way up either. So what you're doing is these income-producing assets you have, things that pay 9-10%. Those income-producing assets that you really like, but are rate sensitive, hedge it out. That's what I'm doing. I've got some things that pay very nice interest rates, but they're hedged out. So we've got this nice cash flow coming in, but we don't have to worry about the day-to-day fluctuation in rates. And that's a package. Those two things go together. Don't look at those investments separately. They go together. So those are the obvious winners today. If we take a look at the S&P 500, something I usually start off with, but let's go ahead and take a look at it backing up here. And for those that are new, we've got a lot of new folks on the podcast. I generally, obviously I'm looking at a lot of different things, but just to keep things simple for the podcast and not to get too caught up down in the weeds here, I usually just have the volume at the bottom so you can see kind of the spikes. We also have the, and I'll turn it to the SPY, which is the ETF, so you can see the volume's a little more relevant there. But we have that, and what I have on here is I've got 4 moving averages. I have the green line, which is a 20-day. I have the blue line, which is a 50-day. I have the purple line, which is 100-day, and it's probably the most underutilized one. And then I have the red line, which is a 200-day. And I have those on there. Plus this gray are Bollinger Bands. So generally speaking, 2 standard deviations away. And to simplify it, usually most of the time you're going to be in between these gray lines. That's why if you can see here, when it went outside of it, it snapped back and went back into it. So a lot of people use it for that. But if you look at the S&P last year, we were in this nice little channel, and it got even better, I'll call it. It went out of it, and it became this new channel. And what's happening is we're simply coming back potentially to the 50-day moving average, maybe even a little lower. So this is just vibration so far. There's nothing indicating that this thing is so overheated that we're due for a 20% drop. Just because we had a good year last year in the stock market does not mean that it's going to fall dramatically this year. Having said that, as I mentioned before, a pullback in the middle of the year, a scary pullback, let's call it 10% or more, is something that is normal during the year. In fact, the average pullback during the year is 14%, and we haven't had anywhere close to that. But in the very, very short run, don't be surprised if we come back and maybe even fall below the 50 and come back and bounce off of that. The uptrend would still be in place, and all it takes is a little bit of good news, I think. So this is a market that was kind of looking for an excuse to sell off. And but again, when you get this combination, this is the key, of weaker data and the Fed taking the punch bowl away, woo, that's scary, isn't it? We were all surprised when the Fed said they were going to start tapering, right? They actually said it, and yet the market went up. It was a shock, but it's because it was supported by better data. That's the real Goldilocks. The Fed out of the way and the economy getting better. And you really have the Fed getting out of the way, and if the economy is getting weaker, that's a bad combination. But let's watch what happens here. Again, you can't if you're going to predict, well, this is the top, this is the top, this is the bottom. You got to watch these things play out over time. So I got stopped out on one position today, but I was actually in there buying a couple of other things for extra cash I had for accounts that were underinvested. So I took advantage of some of the little bit of fear. Speaking of fear, let's take a look at the volatility index, and you can see we're not this barely registered on the Richter scale on the map here. This is the volatility spiking up today. This is fear up here. This is not fear so far. But there are other indicators I'm watching that showed we had a lot of complacency in the very, very short term. So we need a little bit of fear back to create opportunities. We want that. Okay, but people are using January right now to lock in some of the gains perhaps in the past several months. You know, even for the year so far, the S&P is actually down 1% for the year. So stocks are down this year in 2014 so far, but the volatility index is down as well. This is down about 9% this year. So we haven't seen, even though the market's pulled back 1%, nothing major, we haven't seen the fear pick up yet. So again, not really so far, not much to write home about one way or the other for the bears or the bulls. So we'll have more earnings coming up over the next few days, and it'll kind of pick up. But for right now, I wouldn't make any major moves unless you were somebody who was overly aggressive last year and got more aggressive as the year went on. This probably is a time to scale back a little bit and get back to where you should be overall. And this is, again, today was a good example, and really the last few days, why you still, some of the things that were really underperforming last year are doing better. So keep that balance in the portfolio, but do not get having one extreme or the other. I don't think is a good way to go.